Good morning. This is Pratiksha Sunil Karambe, Assistant Professor of Maratha Mandir, Babasaheb Gavde Institute of Management Study. Today we are discussing the topic of accounting conventions. Now, accounting conventions are accepted principles, or you can say practices, that every accountant need to follow while preparing financial results. Now, why we are doing this, or why we are using accounting conventions? Because it gives you a clear understanding. It is consistent, it is simple, and it gives you clear understanding how to use accounting, or how to compare your financial results, and how to complete your accounting by using the conventions. So there are basically 4 accounting conventions. The first one is what? Convention of consistency, convention of full disclosure, convention of prudence or conservatism, and convention of materiality. Now we will discuss one by one how each component or each convention play important role while preparing financial statement. The first one is what? Convention of consistency. Now, convention of consistency says once you choose one method of accounting, you have to stick it. For example, if you are using a single line method for calculating depreciation for 1 year, you have to complete it, or you have to follow the same method for the next year too. In simple language, for example, if you are tracking your expenses by using Excel sheet and for every month, and if you all of a sudden if you shift to the mobile application or a diary for calculating your expenses next month, then it would be difficult for you to compare your expenses. That is nothing but what? Convention of consistency. It should be consistent every year. Then the second component or a second convention is convention of full disclosure. Now, what does it mean? Convention of full disclosure says you have to tell each and every important information that is important to understand the true financial position of the company. Means, for example, you are going for a loan, then you don't only shows your salary slip, but also you have to disclose that how much loans or how much existing EMIs you are paying. By calculating this, your banker tells you that you are eligible for this amount. Then the third principle or the third convention is convention of prudence or conservatism. Now, convention of prudence or conservatism tells you have to anticipate losses first, but never disclose your profit or expected profit. Like in other words, for example, if you are facing that you may lose something or you may lose money, then you have to record it immediately, even if it hasn't happened yet. But you are feeling that you may gain something or you may gain a profit, wait until it's confirmed. Then the last convention is convention of materiality. Convention of materiality says focus on information that is significant or that carries value or that is material enough to influence decision, and ignore the little one or ignore the minor details which don't influence the decision. For example, if you purchase a pen of rupees 2, you wouldn't record it. But if you purchase a laptop of rupees 25,000, you would definitely record it, because it carries value or it carries material. That is nothing but what? Convention of material. So these are 4 conventions, that is convention of consistency, convention of full disclosure, convention of materiality, and convention of prudence, which carries a huge value while calculating financial statements, because it gives us clear understanding how to calculate or how to frame your accounting. That's it from my side. Thank you so much. If you like the video, please share it, subscribe it, and like it. Thank you.